Stop the presses. People, the market is growing slower than it's ever grown before. It's almost not even worth putting your money into stocks. Any gains that you get will probably be wiped out by inflation. And what if the market goes down? What if it goes down? Somebody hit the panic button. I'm losing my mind here. Hey everyone, Daniel here from Next Level Life, and today we're going to be covering a question that I'm sure you've seen at some point in, well, a lot of financial articles over the last few years, and that is whether or not the market is actually growing at a slower pace than it was in the past. Now, I've heard a lot of people say that the last 15 years have been the worst in the stock market's history, but is that really true? Is the market really growing slower than ever before? And if it is true, is it still worth it to invest? Well, the answer is a little bit tricky because, as is the case with a lot of financial questions, the answer is, it depends. And it depends on a few factors. The first is what time frame you're using to make the claim. For example, if you look from September of 2000 to September of 2017, when the audio is being recorded for this video, then there's no question that the market's been growing slower than usual. Like I've said in previous videos, the S&P 500 has grown at a rate of about 8.6% per year from September of 1978 to September of 2017, which is way more than the 2.5% per year rate from September of 2000 to September of 2017. However, that's basically starting from the absolute peak of the market before the dot-com bubble burst, and only looking at a fairly short period of time to gather your results. It usually takes a few years for the market to rebound. You could also say that the market's been growing faster than it ever has before if you were to look from September of 2009 until September of 2017. During that time period, the market's growing at about 13% per year on average. But of course, that has the same problem in reverse because you're basically starting from the bottom of the market after that crash of 2008 and examining only a short window of time to back up your claim. And what's more is you're not taking into account all the factors. In essence, you're almost asking the wrong question, because whether the market is or is not actually growing at a slower rate than before isn't the most important thing to know. No, the most important thing to know is what's happening to our individual buying power, because money is only as good as what it can buy. One of my finance professors back in college always used to talk about how you could fall asleep for 100 years with a couple $1,000s invested in the stock market, and when you wake up, you realize that all of a sudden you have $1 million invested in the market and you're thrilled. You'd probably call all your buddies and tell them you're taking them out for dinner and it's on you. Then you go to your local McDonald's and realize that one Big Mac is gonna run you about $2,000. Suddenly you don't feel as rich anymore. So again, money is only as good as what it can buy. And on a side note, I kind of like how this character in my finance professor's example realizes that he's a millionaire and the first place he thinks to take his friends is still McDonald's. I'm sure there's a lesson about the power of habit in there somewhere. Or maybe this particular character was just cartoonishly frugal. Anyway, getting back on topic. In order to figure out what it can buy, you also have to look at the CPI, or the Consumer Price Index, which is basically a way to get an idea of what inflation has been during a certain time period. The CPI basically measures a weighted average of prices of a basket of consumer goods and services, including food, beverages, housing, apparel, transportation, medical care, recreation, education, and some other goods and services, and it sees how quickly the prices for them change over time. And sometimes, though not always, you'll see that when the CPI is increasing very quickly, so is the market. A great example of this would be between the years 1979 and 1983. During that time, the market was growing at an average rate of about 12.5% per year. However, inflation was almost keeping pace with that. We saw an 11% increase in the CPI in 1979, a 13% jump in 1980, a 10% boost in 1981, and a 6% and 3% increase in 1982 and 83, respectively. That averages out to an inflation rate of almost 9% per year during that time, meaning that your effective increase in buying power only went up by about an average of 3.5% per year from 1979 to 1983. Even though the market was going up very quickly. So when you look at it from a buying power perspective, has the market really been doing that bad these last 15 years? And as it turns out, not really. If you look at the market as a whole for the 40-year period from 78 to 2017, you see that it's grown at an average of 8.6% per year. During that time, the average inflation has been about 3.7%. meaning that your increase in effective buying power during that time is about 4.9% per year. But in the last 15 years, so from 2003 to 2017, the market has grown an average of 7.2% per year, which on the surface is lower, but the average inflation rate during that time has been about 2.1% per year, meaning that your average increase in effective buying power has been about 5.1% per year. So there you have it, my friends. Technically, if you're looking at it from just a market appreciation standpoint, the market is growing slower than ever before. But if you take into account what you can actually do with the money that's appreciating, it doesn't really look all that bad. But that'll do it for me. I hope you enjoyed this video, and if you did, or if you learned something, be sure to like and subscribe. I've got a lot more of these finance videos coming out in the near future, as well as some more book summaries and other fun stuff. But with that being said, thanks for watching, and have a great day.